Second speaker is Adam Rowe, who's the General Manager, Trade and Commodity Finance, Rabobank Australia and New Zealand. And Adam's had, as you can see from his CV, quite an extensive amount of experience, particularly in commodity financing. And when you look at the team of, or the list of organisations that he's been involved with in one or another, it certainly displays a wealth of experience in the agri sector and the financing thereof. So I'm sure there'll be some very interesting insights from Adam. So please welcome him.
Thanks, Mick, and good morning. Thank you to Karen for quoting us in one of her presentations. So thank you very much. I think Rabobank is obviously has a long-standing relationship with the food and agri industry here in Australia. We like to advertise ourselves as the only international focused food and agri bank, and here in Australia we enjoy having a wide coverage across the whole spectrum, from our 60 rural and retail branches here in Australia, our 30 branches in New Zealand, and in fact we have one of our branch managers here today to experience the seminar. So it's very nice to be able to provide in a whole spectrum. For my presentation, I'm not going to talk about statistics, so obviously you've spoken about those over the last presentations in a couple of days, but I really want to focus on something which we use extensively within commodity trade finance, and that's the humble letter of credit, and how for exporters and for players within the food and agri sector, we can actually add benefits and add protections for letters of credit and also following on. And then I did want to just touch base on something which is a real niche for Rabobank here in Australia, and that's our ownership-based financing product. But and then obviously at the end some questions, and I'm happy to answer. So I mean, effectively what I want to start with is what internally within Rabobank we define as commodity trade finance. And it really is the focus on lending in relation to the reserves or inventories or receivables in relation to exchange-traded products or physical commodities. And for us, it's important in relation to the physical commodity. That's really what the focus is for Rabobank and focus for my team. It's following that physical from the farm gate, or even for my rural colleagues from the farm itself, but for a commodity finance department, it's from the farm gate all the way through to the ultimate off-taker. And whether we use products in relation to domestically Australia, or then linking up with our with our regional or international hubs, or using partners such as EFIC, we add value to our customers. Primarily my customer focus within the Rabo chain, and that's the supply chain which we work with internally, but my focus is really within the trading community, whether that be domestic traders such as GrainCorp, or the international trading houses such as our friends here at Cargill, Glencore, Bunge, ADM, and so forth. And really where we like to play, or where we like to see our niche, is providing value from that domestic trade, international trade, inventory finance, and through to food processing. But what we also like to see is, obviously, for a financing solution, is to have Rabobank linked at either stages of that. So working with the farmer, the grower, then working through the sale, whether that be to a trader or through to international trading houses, and then following that through to regional off-takers, whether that be in Asia or Middle East or in the Americas. I'd like to also need to thank my colleague Georgia, who is here from our from our food and agri research team, has provided me some of these graphs. But I mean, some of these we just throw up internally within Rabobank, just to link in that there are great access, great environments, and great challenges and opportunities for Rabobank to add value to food and agri exports, and also to add value to business within this regional Asia Pacific area. Again, it's just a concept that we like to say internally is about Asia is 64% of exports, but is also the Middle East, which we've had a long association with, Africa, where we have branches labelled as Rabobank, or through our Rabo Development Network, and also into the Americas. I was very pleased to see that some of the figures that were put up this morning match the figures that we have internally. Obviously, there's some growth there in the North Asia, but it was also pleasing to see the growth for what we see from our business in Southeast Asia and also the Middle East. This is a slide we like to use internally, particularly because we are an outpost of a Dutch cooperative bank. Sometimes they have a preconceived conception of what Australia and New Zealand does, and whether we punch above our weight or not. So it's always pleasing to be able to, in presentations, provide this type of slide to show that Australia and New Zealand really do punch above their weight, and Australia and New Zealand are actually very important within the global food and agri cycle. Whether it be from dairy, from sheep, as we heard this morning, beef, sugar, which is obviously going through its own developments at the moment, into wool, which we're seeing increasingly high prices for. So we're seeing that as a focus for us, and that's what we like to do internally to show that Australia and New Zealand is vital, whether it be feeding domestically, whether it's the food bowl for Asia, or whether it's expanding that into the Middle East and Africa. But on the flip side, and it's something which a lot of our European colleagues then throw back in our faces, but it's also an important statistic, is if you look at Asia as an export market, Australia and New Zealand only make a small slice of that. So we see there's great opportunities to grow on that, great opportunities and great challenges to expand those types of percentages. As a subset of what we call commodity trade finance is really what we call vanilla trade finance, and that's what really made banks 150 years ago develop into assisting imports and assisting exports. And that was really in relation to the documentary trade and the elements of how you get products from one side of the globe to the other, and how do you get products from a seller to a buyer, and the money from a buyer to a seller. Inherently there's mistrust, and you end up developing concepts such as letters of credit and vanilla trade finance. So within our subset of what we call commodity trade finance, we have vanilla trade finance. The definition is self-explanatory, but it's really in relation to understanding that we look at the underlying physical commodity, how that underlying physical commodity is transferred, and what is the documentation that refers to that underlying physical commodity. We like to look at this as what we call the risk spectrum, and it is a concept in relation to where we would like to see both exporters and importers looking at using solutions which fall in the middle of the spectrum, but obviously commercial imperatives, negotiations allow parties to push or use their market share to move to the extremities of the spectrum. So on one side you have what we call the least secure, which would be open account, where exporters are exporting commodities to off-takers in Asia or North America or Middle East on the back of a contract, and simply taking the open account risk on that off-taker to pay, whether it be 10, 15, 30 days later. All the way through to what that exporter would call the most secure, which would be obviously getting 100% cash in advance to that offtake. Now obviously they are the extremities of the spectrum. Obviously in some instances, parties to contracts will enter into those arrangements, long-term arrangements, been dealing with each other for 15 years, or that is what is occurring in those regions. But we would also, as a bank, in relation to financing these types of transactions, we would rather see both the exporter and the importer, or the counterparties in relation to a transaction, come closer to the middle of that spectrum to look at documentary collections, which are letters of credit, guarantees, performance bonds, and then understanding how that works to assist the exporter and provide support for the exporter, but also provide support for the importer also. Within banks, we always like to talk about calculating risk, and it really becomes about a risk-reward calculation for our credit committees, and in relation to how we undertake financing of customers, or whether we support transactions or so forth. So I thought I'd just throw up a couple of slides. Obviously at the bottom, everyone wants the money at the end of the day, but in relation to that we need to understand where the risks are, how that money is going to be transferred, how it's going to be used, and for what purposes. And obviously then we just throw in banks, sliding banks. The concept of the strength of a bank is also something which is important. And for Rabobank, in relation to its rating, in relation to its long-standing history within food and agri, we like to use that as a selling point, as a comparative advantage, because of the Rabobank cooperative nature in relation to our understanding of banking, our understanding of the food and agri aspects of banking. We see that as stands us above our competitors, whether that be here domestically in Australia or obviously globally within our global trading peers. Really, in relation to whether it be documentary credits, whether it be imports, exports, whether in relation to FIC guarantees or whether it was funding open account, it really comes down to what is a country risk, and are the counterparties prepared to accept that country risk, and have they calculated that country risk into their margins, into their calculations, into their negotiations. And sorry, there's a lot of information on that slide, but I wanted to get through the concept that for a bank like Rabobank, it is understanding where the exports are flowing to, how those exports are being flowed, how they're being paid for, and then understanding where that sits on our country risk spectrum. And I just want to throw in a few. I mean, obviously an issuer of a letter of credit can be in Russia, Bulgaria, Turkey, but obviously then it is an export coming out of Australia, so you are taking a certain percentage of that country risk in relation to the transfer of funds, whether the bank that's issuing that LC is stable, and whether the actual geopolitical circumstances within that country are also stable, which will allow the transfer of funds outside to be paid, obviously, which is the ultimate concern for exporters. And then on top of that, you overlay sanctions, you overlay customer due diligence, you overlay bribery concerns, and a whole lot of other aspects and metrics. And I've just included a couple of slides in relation to, a couple of standings in relation to corruption's criteria. And for us, and there's something which our country risk committees look at, or something that our credit committees look at, and it's something which we include within our applications. It's not simply a customer comes and asks for $100 million and we say, fine, thanks very much, here's the LC. There's a much more of a sophisticated research behind it to make sure that we understand where that flow is occurring and what is actually transpiring in relation to that flow. So it's important to understand where we are trading with. It's important to understand where the funds are flowing from and how they're going to be taken out of a country or deposited into a country. Excuse the orange. It's our internal colour for the Dutch. But in relation to this concept, I wanted to outline where we as an institution have bank lines and we cover country risk. So taking out our speakers this morning, we have a long history in the Middle East and North Africa as an example. From a global concept in relation to bank lines, Rabobank has somewhere in the vicinity of 650 separate banking relationships with banks across the globe. And what that does is allows Rabobank to provide greater depth in countries. Take China for an example there. Everyone can confirm and everyone can take risk on the top 5 Chinese banks, but Rabobank as an institution looks at the top 5, then looks at tier 2, tier 3, tier 4, which then allows us to have a much greater coverage in relation to regional areas. In the Middle East, we were in most of the Middle Eastern and North African countries, even through the Arab Spring. I was in London at the time, and we still managed through our processes to confirm LCs from Tunisia, from Morocco, from Egypt. Obviously, bank lines have much greater concepts in relation to protections or influence over length of tenor and maximum, but we were still able to do it, and we were still able to add protection to exporters who wanted to export their products to those jurisdictions. Obviously, we haven't listed the industrialised countries. I mean, very rarely will I be asked to confirm a bank from an LC from the Bank of Citibank or Bank of America, but we do often get asked to confirm banks from Brazil, from Argentina, from Chile, from Thailand, Vietnam, Philippines, Egypt, Lebanon, Oman, Saudi Arabia. And it's really about the humble LC, which in international trade finance makes the process run. It's the oil that facilitates exports from one country to the other. Traditionally, we've seen a high use of LCs in the Asia-Pacific area, whether they both be imported LCs or export LCs. Recently, probably in the last 12 to 18 months, I've seen a bit of a coming off of those percentages as companies look at entering into more open account arrangements with their counterparties. But the humble LC still exists. The humble LC still moves within certain criteria. In much of Europe and North America, they're using electronic LCs now. What I like about the Asia-Pacific area, that's still very old school. A lot of counterparties, a lot of companies want to see physical hard copy LCs, which is quite nice. It's what was created 150, 200 years ago when banks were mercantile and were looking at the exchange of documentation. And for us, I mean, this is the flow in relation to LCs. And if you say from the SWIFT network, and this comes from the International Chamber of Commerce, but in 2013 there was 4.8 million LCs transacted through the globe. And that is, I say, it is the oil that makes trade finance run. But it's a concept which is very circular. There's a flow of goods, there's a flow of documents, and there's a flow of money. And in relation to those concepts, then becomes a situation of where we're looking at where these LCs are being issued. And if you look at, I just pulled out a couple of old school copies. One is actually from the Bank of New South Wales, and other ones from the Commonwealth Trading Bank of Australia. So you can see how old these types of documents are. And as a tangent, they've actually become quite a collectible item. So all those LC departments in banks 25 years ago that dumped archives of LCs are now trying to chase them up and see if they can be actually worth valuable to collectors. But it's the flow of international trade that the humble LC facilitates, which is what's important to a bank like Rabobank. And I think it becomes more important for us when we become the confirming bank. And that's what I say about our 650 separate bank relationships across the globe. It's that ability to confirm that credit of that bank, which then facilitates faster payment to the counterparties, faster facilitation of documentation, and a more secure transaction for all parties involved. And we see that as a real selling point in relation to commodity trade finance. It's a very low margin, high volume business here in Australia with very high competition between ourselves and the domestic four. But it's a process which I think adds value to traders, adds value to exporters, and should be used when people have concerns or people are moving into new regions and new areas. It gives them a level of protection which is not afforded to by simply meeting someone in an industry body forum and entering into a contract. This is a structure, legally binding, and irrevocable undertaking from a bank to pay, and the confirmation then provides you coverage in relation to that irrevocable promise to pay. To finish up, it's the concept which has a real niche and a real sophistication for Rabobank locally, and that's what we call our ownership-based financing solution, or structured inventory products. And it's an add-on in relation to vanilla trade finance and commodity finance. It's where the bank partners with exporters, the bank partners with F&A producers, and actually purchases the commodities onto the Rabobank balance sheet to provide savings for the producer and also to facilitate trade. It can take up various structures, as I've listed there, from what everyone would know as a repo, where the bank would buy on a Monday and sell back to the customer on the Friday, to a much more sophisticated regimes which are just in time, where the bank purchases off a producer, off a grower, off a trader, and then facilitates that trade, whether it be domestic or export, to the end off-taker. So what it does is allows the counterparties to have greater protection in relation to their offtake, provides them with cheaper funding in relation to vanilla working capital facilities which other banks provide, provides the bank with greater insight into the client's business, and it also, in some instances, allows balance sheet management tools, which then adds to the ability to use working capital elsewhere. What I said before is it talks about price volatility. We need to look at the liquidity of the commodities involved. Obviously, the price risk is something which needs to be catered into. So we look at commodities, and in Australia, within Rabo, we are the centre of competence globally for this type of business. The Australian sector, particularly in the agricultural sector, works very well, where we are predominantly an accumulator of primary products for export, whether that be grain, sugar, cotton, wool, sorghum, or also we're looking at cottonseed almonds. It is an ability to manage the volatility of price, but also manage the inventory financing requirements over a season, which then allows the trader, allows the commodity player to then export bulks, whether that be export bulks to their regions, also then to sell on domestically. And we see that as a great benefit for the Rabobank and a great benefit for our customers who utilise these solutions. And these are just some of the advantages. Obviously, there's got to be advantages for the bank. We're a commercial institution, so we're always going to be in it for advantages for the bank, but we also see great advantages for the borrower, as I've said. Number one there is the ability in relation to discussions with their internal auditors to have off-balance sheet treatment or limited balance sheet treatment. It's an alternative funding possibility to clean working capital. Which in some instances can be restrictive in relation to covenants and also can be expensive. For us as a bank, I see it as an ability to see much greater insight into a customer, into their supply chain, and also then linking up possible other TCF Rabobank hubs in China, in Indonesia, in North America, in Argentina, with the export of those commodities to see if we can actually see both sides. Then that adds a benefit to Rabo and also adds a benefit to our customer because, in fact, Rabobank are paying Rabobank in relation to the flow of the commodity finance. Risks are obviously there, and that's why we think food and agri commodities work the best because they are highly liquid. There's great markets, there's many players, and there's also lots of independent reference prices. So risk are the ownership liability, price risk, how we secure title to the goods. Obviously in a silo you have the problem of my grain mixed with the client's grain, mixed with ANZ's grain, mixed with CBA's grain. So there's also a concept that the bank needs to get comfortable with. And obviously then storage, which means inspecting storage sites, maintaining lists in relation to authorised storages and making sure that their fumigation and their risk management processes are up to date. But for us, it's a great product. We like to use it. It's used extensively within our international trading community, and we like to see whether in the new focus for the bank in relation to maintaining our level as a major player in domestic food and agri businesses, to see whether we can flow this type of product down to other layers to extend the supply chain. So not just so much more about international traders or the trading houses, but whether this can be supplied to SMEs, whether it can be supplied to large farmers who accumulate or aggregate on behalf of other farmers. So we see this as a great opportunity to work with the Institute, to work with people like EFIC, and also work with our other banking peers to make sure that we have a process which works and a structure that adds value to the customer, which is obviously the ultimate goal for us. Thanks very much. As I kind of rushed through a little bit of that, but it's more to give you a bit of a flavour of what we see as the value add for Rabobank, particularly in F&A business and particularly in relation to the commodity trade finance. We work very well with EFIC, and it's good to see that I'm sharing the stage with Karen. But it's also an ability, thank you to Mick and the Institute for allowing us to give a little bit of a snapshot of what Rabobank does, and I'm here with my colleagues, and if you need to have any more discussions or questions, please, I'll be here all afternoon to answer them. Thanks very much.